Hello and welcome back to Market Brief After Hours. It is the end of January, and frankly, what a way to close out the month. We had a little bit of everything today. Political headlines with a new Fed chair nominee, absolute chaos in the commodities pits, and a tech sector that just couldn't find its footing.
It was certainly one of those sessions where you couldn't look away from the screens. We had President Trump nominating Kevin Warsh for the Federal Reserve, which the market generally took as a positive, but that sentiment was completely overshadowed by a historic collapse in precious metals and some very heavy selling in technology. It was a volatile finish to what has actually been a net positive month.
Let's dive right into the numbers because there is a lot of red on the board for Friday, even if the monthly view looks better. Let's start with the major U.S. indices. How did we finish the week?
It was a broad retreat. The Dow Jones Industrial Average fell 179 points, closing at 48,892. That's a decline of 0.36%. We saw financials and industrials trying to hold the line, but the selling pressure was just too widespread. The S&P 500 extended its losing streak to 3 days, dropping 0.43% to close at 6,939. At one point in the session, the S&P was down over 1%, so we did see a little bit of a recovery into the close, but it was still a weak showing.
And the Nasdaq seemed to take the brunt of it again.
It did. The Nasdaq Composite underperformed the other benchmarks significantly, sliding 0.94% to finish at 23,462. We saw mega-cap stocks and software names really struggling there. Investors are getting nervous about stretched valuations and slowing growth, and that hit the tech-heavy index the hardest.
But despite this rough Friday, January as a whole wasn't a wash, was it?
No, surprisingly not. Despite the late-month turbulence, the Dow ended January with a 1.7% gain. The S&P 500 finished the month up 1.4%, and even with the recent slump, the Nasdaq secured a 1% monthly gain. So the underlying resilience is there, but the tone definitely shifted in the last few days.
You mentioned chaos in the commodities pits earlier. I think that might be an understatement. We saw a collapse in metals that people will be talking about for a long time. What exactly happened with gold and silver?
Collapse is the right word. It was a historic rout. Let's start with gold. It plunged 10.11% in a single session to close at $4,836. We saw it trade as high as $5,451 and as low as $4,683. Technically, it posted a massive bearish candle that wiped out weeks of gains.
A 10% drop in gold is rare, but silver was even worse?
Silver was unbelievable. It tumbled 29.42% to close at $81.73. It is the worst session on record for the metal. It traded between a high of roughly $118 and a low of roughly $74. This was pure capitulation. It looks like a combination of margin calls and forced selling by retail traders. When you have a move that violent, it triggers a liquidity event where traders have to sell whatever they can to cover losses, which likely spilled over into the equity markets.
That explains some of the risk-off sentiment we saw in stocks. Before we move on to the currencies and specific stocks, let's look across the Atlantic. While the U.S. was struggling, Europe actually had a very strong close to the month.
They really did. It was a completely different picture over there. The Stoxx 600 rose 0.5% on Friday. The standout was really the UK's FTSE 100, which closed the month up almost 3%, specifically 2.94%, finishing at 10,224. That marks its largest 7-month point gain since 1999.
That is significant momentum. How about the rest of the continent?
Green across the board. Spain's IBEX reached an all-time high of 17,880. In France, the CAC 40 gained 0.54% to 8,115. Italy's FTSE MIB climbed 0.94% to 45,498. And Germany's DAX rose 1.13% to 24,583.
What was driving that optimism in Europe?
It was a mix of earnings and data. You had strong earnings from companies like Adidas and CaixaBank supporting sentiment. On the macro side, euro area unemployment fell to 6.2%, and German GDP grew 0.3% quarter-on-quarter, which beat expectations. However, it wasn't all perfect. German unemployment did spike and inflation is rising, so the outlook is a bit clouded. But for Friday at least, investors focused on the positives.
And briefly, looking at Asia before we take a break?
Asia mostly tracked Wall Street's earlier losses. Hong Kong's Hang Seng dropped over 2%, and China's CSI 300 fell 1%, largely led by those gold-related shares we discussed.
Japan's Nikkei slipped just a fraction, 0.1%. The exception was South Korea's Kospi, which edged higher, continuing a strong start to the year.
We are going to take a very short break. When we come back, we are going to get technical with the Forex market. There are some key moving averages being tested, and we'll look at the specific companies that moved the market today, including a massive drop for Microsoft. Stay with us. Welcome back to Market Brief After Hours. We've covered the indices and the commodities crash. Now let's look at the currency markets. It was a busy day for FX traders. Let's start with the euro against the dollar.
The Euro-USD pulled back sharply. It closed down 0.96% at 1.1859. We saw a bearish engulfing candle, which is a technical term for a chart pattern that often signals a shift in momentum. Essentially, heavy selling erased several days of gains.
Where does that leave the pair in terms of its technical trends?
Despite the drop, the broader trend is still constructive. The price remains above the 50-day simple moving average at 1.1704 and the 100-day SMA at 1.1678. It's also comfortably above the 200-day SMA at 1.1607. So while the near-term sentiment has deteriorated, the longer-term structure hasn't broken yet. Immediate resistance is back up at 1.1975.
We saw a similar move in the British pound, didn't we?
Yes, very similar. The GBP-USD retreated from multi-month highs, ending down 0.90% at 1.3689. It faced a clear rejection near the 1.3800 level. But again, looking at the moving averages, the price is still above the aligned 50, 100, and 200-day SMAs, which are clustered around 1.3420. The medium-term trend is positive, but short-term momentum has definitely weakened.
What about the Canadian dollar?
The USD CAD actually rebounded. The US dollar strengthened here, climbing 0.93% to 1.3615. It bounced off an intraday low of 1.3482. However, unlike the euro or pound, the broader trend here still favors sellers. The price remains below the 50, 100, and 200-day SMAs, which range between 1.3820 and 1.3894. So this looks like a relief rally or short covering rather than a trend change.
And the yen?
The USD JPY staged a strong rebound, closing up 1.09% at 154.75. It moved back above its 100-day SMA at 153.78 and is approaching the 50-day SMA at 156.32. Crucially, it held above the 200-day SMA at 149.87. This suggests the medium-term structure remains constructive for the pair.
Finally, the Aussie dollar, which usually reacts to commodity prices.
And it reacted predictably. The AUD-USD suffered a sharp pullback, slipping 1.18% to 0.6966. It formed a strong bearish candle. However, it's still holding above the rising 50-day SMA at 0.6883. As long as it holds that level, the broader uptrend is preserved, but a break below that would point to a deeper retracement.
Moving away from currencies, let's touch on oil. With all the volatility elsewhere, what was crude doing?
Oil was actually consolidating near 6-month highs. Brent crude settled almost flat, just down a fraction to $70.69 per barrel. WTI rose 0.54% to $65.77. The market is still being underpinned by U.S.-Iran tensions. Investors are worried about supply disruptions, so despite the risk-off mood in stocks, oil prices remain supported by those geopolitical risks and tighter near-term fundamentals.
Let's talk about the companies that made headlines. We mentioned the tech weakness earlier. Microsoft had a particularly rough day.
It was brutal for Microsoft. The stock dropped 10% following its earnings report. That move alone erased over $350 billion in market value. It was a major drag on the indices. We also saw KLA Corp sink more than 15% after issuing weaker guidance.
It wasn't just big tech, though. The gaming sector took a hit, too.
Yes, there's a lot of fear regarding AI disruption in that space. Unity software fell more than 23%, Roblox dropped over 12%, and Take-Two declined more than 7%. It seems investors are reevaluating the future of these business models in the face of rapid AI advancement.
But there were some winners. Who managed to buck the trend?
Verizon was the standout. The stock surged nearly 12% after posting strong earnings and guidance. That was its best trading session since 2008. Also, Decker's Outdoor jumped over 19% on upbeat sales and upgraded forecasts. So if you were in the right pockets of the market, specifically telecoms and certain consumer goods, you had a great day.
We started the show mentioning the new Fed chair nominee, Kevin Warsh. We also had some economic data come out regarding inflation. How did those two things interact?
It's an interesting dynamic. Investors broadly welcomed the nomination of Kevin Warsh. However, the data complicates the picture for the Fed. We had hotter than expected producer price index, PPI data. Core PPI rose 0.7% in December, which exceeded forecasts.
And that affects the Treasury yields?
Exactly. Treasury yields held firm because that hot inflation data reinforces the idea that the Fed might have to maintain a cautious policy stance. They can't just slash rates immediately. The 10-year yield rose to 4.251%, while the 2-year eased slightly to 3.531%. It signals that the market is pricing in a higher-for-longer scenario, or at least a pause, despite the leadership change.
We also saw some data from Canada regarding growth.
Yes, Canadian GDP grew 0.1% month-on-month in December and 1.3% for the year 2025. It points to modest, steady expansion, nothing explosive but avoiding recession.
So as we wrap up January, we have a market at a crossroads. We have resilient economic data, a new era of Fed leadership, but we also have collapsing speculative bubbles in metals and some serious questions about tech valuations. If you found this useful, please follow Market Brief After Hours on your preferred platform. We will catch you next week.